I've addressed the latest LBMA attempt to steer Western traders away from gold, just like they failed to block allocated gold becoming a first-year asset in January 2023, $1,600 at the time, and closing yesterday's options expiry at $1,700 higher than that, $3,300. They might be able to inject some short-term unallocated gold and silver volatility, which sure they can, for the reasons we've explained. But they cannot stop gold becoming a global first-year asset class, even if they are dragged and kicking and screaming into a physically determined gold price. Most importantly, it unshackles, and this is important, it unshackles these poor producers, opening them up to a competing, fairer, physically determined gold price.
The introduction of Basel III regulations marks a turning point in the gold and silver markets, fundamentally altering the dynamics between physical and paper-based assets. The distinction between allocated and unallocated gold is now more significant than ever, with regulatory changes reducing the viability of speculative, non-physical positions. Increasingly, investors and financial institutions are being incentivized to hold physical gold, not just for its historic role as a safe haven asset, but also because of its full recognition as a top-tier high-quality liquid asset under Basel III. AndrewMaguire highlights the ongoing shift in gold and silver price discovery away from speculative Western futures markets toward transparent, physically backed systems. With gold now recognized as a Tier 1 asset by the BIS, banks can count 100% of its value in reserves, only if they hold it physically, unlike the previous 50% allowance. Basel III's requirement that 85% of unallocated precious metals be backed by equity has made paper gold positions costly, pushing banks to reduce exposure and exit leveraged trades. This has reduced liquidity on Western platforms, revealing the fragility of markets heavily reliant on synthetic gold. As a result, physical bullion is gaining favor, especially among central banks and institutional investors. Meanwhile, demand from the East continues to rise, with the Middle East showing growing interest in unwrought and powdered silver, highlighting both industrial and investment-driven momentum. Despite ongoing efforts by Western institutions to suppress silver prices through synthetic short positions and momentum-driven trading, the tightening of physical supply and sustained buying from the East point toward a possible silver revaluation. Silver's price has historically lagged behind that of gold. Still, the current structural and regulatory shifts suggest a catch-up rally may be on the horizon, especially as physical demand continues to grow. Regulatory frameworks emphasize the importance of tangible assets over speculative investments. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
All the way along, we've seen where the West sells. At the end of a day, Asia then picks it up and buys it. And so we've been seeing the Asia buying what the West has sold. But what we saw is that there was a change in behavior, which is, so what they're doing is letting the West run the next day with their pre-sold positions, knowing that they would just come in. And so what we would see is China then coming in late in the Asian session to capitalize on the West's bearish skew. And this has been quite evident. No matter how hard the West sold, we evidence consistent and very, very strong showings at all the Asian-facing AM fixes. Now, while the PBOC is completely price insensitive, and they're going to continue to exchange dollars for gold at every global AM and PM fix, doesn't matter what the price is, they're very disciplined. And they also use paper-induced volatility to load up or capitalize on paper-induced volatility to load up official monetary gold reserves without driving the price higher. In other words, they are alchemizing dollar price paper gold into fully paid for 400-ounce bars, which do not populate the COMEX. They do not populate the unallocated, the normal unallocated flows. This is monetary gold, and it's under the radar, the bulk of which avoids reporting requirements. And some of this PBOC buying will actually be reported at the end of this second quarter. Obviously, it's not reported yet. Now, very short term, as we headed into options yesterday, we get more evidence that China is capitalizing on the West's attempt to cap gold below 3,300 at the PM fixes. Once again, I think we've seen it again today. once again buying into so what they're doing is buying into the Asian facing AM fixes and then allowing the West to run with it, and then they'll just pick up the discount. This physical demand is really what drove June gold into backwardation to spot. So the June contract is just about to expire. It has to go into delivery in 2 days. It's into first notice tomorrow, and it has to go into delivery. So essentially, that should be trading at the same price as spot. No, spot is commanding at least a $2 premium over this contract as people race to cover. While silver futures have been influenced by the momentum short sellers crossing over their selling activities in gold futures and affecting silver, no bullion bank is naked short silver, with both gold and silver sell-offs have been officially driven and OCC related. So what we're going to do is quickly hop in and have a look at the charts for this. It's much easier. A lot of the synthetic action in silver is buried in this gold-silver trade, this basically the ratio trade, which is currently being unwound from its 120 to 1, 120 ounces to 1 ounce of gold COVID spike, and that was the 2020 highs right here, down to right now into the 98.99 level, which is ridiculously high. What we're going to see now, I think what's happening is we're seeing this unwind into really the objective is now to try and exit this underwater trade as best as possible. Now, the silver futures pit managers have also been evidenced as ringing the register on freshly added momentum speculator shorts here. So that was sucked in a bunch of momentum sellers and then immediately rang the register. As we know, the COMEX is run like a casino. Essentially, it's a rigged casino, and essentially 95% a house will win 95% of the time. And why? Because they finance and take the other side of all the chips borrowed from the casino. So you can automate, once you start a sell ignition, i.e. here there would have been long stops. Once you've targeted a few, then the short sellers come in and they're naked short at this point. And they're exactly where they want to pull that register, ring the register is exactly where. So now this is where we looked at last time. This is what we figured would be the low. And this, as we looked at earlier, was the options sweet spot, 33 options sweet spot. And it's consistently evidencing strong pit manager support, COT support and I'll show you this, and it's so blatantly obvious. And this just reflects an algo that's in play. This is a bull algo that's in play. It's just represented by a Fibonacci retracement, but it's a question of where you anchor these that is so important. But also looking at the footprints and liquidity provider footprints, this is major support. And what that does is, because we've had significant support at that level, what that does is open up the related, makes the 36,585 related target for this algo magnetic. Now, while silver futures have been influenced by momentum short seller crossovers from gold futures, large offside foreign exchange silver OCC bets that were being marked to market into April month end here, and the May contract month end, essentially these contracts and dips sub 32 have aggressively been bought by very active Indian and Chinese buyers. In fact, most liquidity providers see silver or a silver price sub $38 as absolutely unsustainable. So in the medium term, silver should actually outperform gold. It's got a lot of catching up to do. So thanks for the questions, everyone. I hope I've addressed the latest LBMA attempt to steer Western traders away from gold, just like they failed to block allocated gold becoming a first-year asset in January 2023 at $1,600 at the time, and closing yesterday's options expiry at $1,700 higher than that, at 3,300. They might be able to inject some short-term unallocated gold and silver volatility, which sure they can, for the reasons we've explained. But they cannot stop gold becoming a global first-year asset class, even if they are dragged and kicking and screaming into a physically determined gold price. Most importantly, it unshackles, and this is important, it unshackles these poor producers, opening them up to a competing, fairer, physically determined gold price. The only question that really matters right now is how much physical gold and silver do you own right now ahead of the next Basel III driven global gold price being determined.
AndrewMaguire emphasizes that Basel III regulations are fundamentally reshaping the gold market. Under these rules, banks must hold allocated, physically backed gold to participate in the global price-setting mechanisms, the AM and PM auctions. This represents a direct challenge to the unallocated gold system, which has long allowed banks to operate with fractional reserves and paper claims vastly exceeding their physical holdings. Now, they are being forced to back their positions with real, deliverable gold, a shift that many institutions have resisted for years. The implications extend far beyond the precious metals market. The enforcement of Basel III signals a broader need to rethink the structure of the international financial system. With the Bank for International Settlements, BIS, owned by 63 central banks representing 95% of global GDP, this regulatory overhaul acts as more than an accounting reform. It is an institutional pivot that reinforces gold's role as a foundation of monetary stability, increasingly recognized not just by private investors but by public institutions around the world. Basel III is accelerating demand for physical gold, particularly among central banks, which view the metal as a safe, tangible asset in a world of mounting financial uncertainty. As banks shift away from paper gold to avoid the higher capital requirements imposed on unallocated holdings, the focus is turning squarely toward physical reserves. This raises an urgent question: will there be enough physical gold to meet this new demand? Let's get back to the interview.
Now, I'm going to put up a couple of links here. CPM Group has tried to remove this 2020 publication titled Bullion Banking Explained, but thanks to GATA, Google searches still find it. In particular, pay attention to the first paragraph on page 3, as it illustrates how, in this case, they talk about silver, how these assets can be collateralized many times over without any physical settlement. Now, this is normal business. So they put it in Bullion Banking Explained. And the resulting deliberately manufactured synthetic volatility enables the cartel to impose unnecessary, highly profitable hedging structures on producers who really shouldn't need it, and refiners and speculators alike. So, as we outlined in our last episode, which I will sum up quickly, COMEX futures contracts to spot exchange for physicals can be forward sold to lock in the EFP premium. So at the beginning of a contract, you may have a $50 premium on a further out contract versus spot. So you sell it and wait for it to come to fruition and try and keep that as profit. But it also gives you bandwidth to play the game. So bearing in mind that the market makers have a footprint in both the CME and the LBMA markets. Now, they can then capitalize on short selling the non-Basel III 15% COMEX-centric haircut, balanced, and I put balanced in inverted here, against an albeit asymmetrically imbalanced, so-called hedged NSFR-compliant long FX gold position, which should be, if called upon, deliverable. So not only has the LBMA been able to capitalize on the 20% unallocated FX gold haircut, because it's unallocated, and which they net out amongst the ring-fence cartel's books, but their COMEX footprint also treats gold as fully unallocated. So net of the open interest that is EFP'd into a full Basel III compliance at the AM and the PM fixes for physical delivery, the combination of these haircuts provides them the ability to gain both sides with relative impunity, largely at the expense of the captive producers. So is it any wonder the RBMA cartel members, sanctioned by the Fed, are doing everything they can to delay the full implementation of Basel III rules that is ultimately going to force the unallocated gold scam to be fully paid up at a real undiluted supply-demand price? And as we evidenced in their now infamous begging letter, which we published back before they were pleading to the PRA before that we don't need to be compliant, and then they were pleading to block allocated gold from being classified as a first-tier high-quality liquid asset ahead of the 1st of January 2023 compliance date, furiously lobbying, even in a letter where they said, and one of the key lines there, they're saying where unnecessary, this could be is unnecessary and could force some banks, quote, including clearing banks, to stop trading. They were threatening the collapse of the entire LBMA system. Now, they failed to block allocated gold from being redesignated as both a high-quality liquid asset and a first-tier asset class. So in other words, their threats were completely manufactured. And the reason they are once again all over the wires, begging for more time while downplaying the price effect of full compliance, because the liquidity providers providing liquidity at the global gold auctions, which is the fixes, they have to be allocated first-tier high-quality liquid asset bullion. It has to be, because it's being physically delivered on a T+1 basis, forcing non-compliant unallocated gold to be fully funded and delivered. So if it isn't there, they have to grab this unallocated gold and force it to be deleveraged. What really is the deleveraging of the COMEX EFP 15% haircut, as well as the related 20% LBMA unallocated gold haircut that is being gamed. In the meantime, Beijing and a growing number of Western-facing physical exchanges, as you've just seen, are busy capitalizing on this foot-dragging process. It's often forgotten, though, that why the BIS stepped in the first place to force liquidity providers to comply with full Basel III compliance, basically. And the requirement to have vaulted allocated gold available to physically deliver at the auctions arose really after the COVID supply shock exposed the highly leveraged LBMA bullion banks as unable to deliver their unallocated gold at the fixes when called upon to deliver. So right, for all the wrong reasons, eh? Now, unlike commodities, which receive a 15% haircut, gold forms a component of an interconnected global FX cross against the dollar, where obviously people forget it's not a commodity. One side is long and the other side is short in the FX market. So both have to be liquid enough to balance each out, and they are settled. So FX gold is money, trading as an FX currency cross, where gold is auctioned twice a day and a price settled against the dollar. Now, unlike a stock or commodity or the commodity markets, global FX markets cannot be halted. And there is always a price for each side of a foreign exchange cross. There just has to be. Now, the COVID imbalance exposed these monetary gold longs as undeliverable, unallocated positions. And at the time, FX trade had a T+3 3-day to physically deliver protocol. But unlike T+3 cash, gold could not be printed, which is what drove these banks to race all at once to short cover these asymmetrically imbalanced futures hedges, driving a massive $100 per ounce premium to close these so-called hedges, illustrating the 100 to 1 ounces of paper gold backing up each ounce held by these LBMA banks. However, after COVID had exposed that the long side of the short dollar trade was almost entirely composed of unallocated gold held by the too big to fail LB-made bullion banks, it was far too highly leveraged to be physically delivered. And that's what almost brought the entire interconnected 2 quadrillion global derivative deck of cards tumbling down. This is such a big marketplace. You take down gold, you've taken down the anchor for every other market. And the task set for Basel III was, and still is, to de-risk the global banking system. With a significant danger detected, and it is in the multi-trillion dollar uneven gold derivative position. That's why they acted. That's why it has to be dealt with.
The evolving regulatory landscape is compelling a seismic transformation in how gold and silver are valued, traded, and stored. As financial institutions confront stricter capital requirements, the emphasis is shifting away from speculative derivatives and toward verifiable physical ownership. This reorientation is dismantling long-standing norms in Western trading hubs and elevating tangible assets as core components of institutional reserves. As central banks and sovereign funds increase their holdings, the precious metals market is entering a phase where authenticity and transparency may define its long-term pricing power. As synthetic instruments lose credibility, the spotlight is firmly on real assets in a world increasingly skeptical of paper wealth. Will the tightening grip of regulatory reforms push the global financial system to redefine what constitutes true value in reserve assets? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.